So you've decided to start investing, but should you? Hi, welcome to the Part-Time Investor, and today I'm talking about should you invest in the stock market or not? Well, to cut the answer short, probably yes, but maybe not now. So there's a couple of things you need to think about before you start investing in the stock market. And the first one is, are your finances all right? If you're worrying about paying bills on a monthly basis and whether you're going to be able to pay the electricity or gas bill next month, then investing in the stock market is probably not the number one thing you should be looking at right now. Now, there'll be people who say, well, you could make 10, 20, 25% by investing in this stock or this thing, but don't treat the stock market as a get-rich-quick scheme, because you'll almost certainly lose money if you do it that way. So please, before you even look at investing in the stock market, number one, get your finances in order. Number two, along the same lines, is pay off any high interest debt. Do you have any credit card loans, personal loans, high interest car payments? Get those paid off before you're looking at investing your money in the stock market. The reason why you want to pay off high interest loans is because, say, anything over 7%, if you're lucky, that's what you're going to be making year on year within the stock market. Now, that's a gamble. You're not always going to make 7, 8, 9, 10%. Whereas if you're paying off a high interest loan, you are definitely going to be making them savings. And £100 saved and £100 earned looks exactly the same when it's in your bank account. Other debts such as mortgages, student loans, maybe low interest car payments, they can be looked at differently. So anything probably below 6%-ish, you can still look to invest in the stock market whilst having those loans. Obviously, if no one invested in the stock market because they had a mortgage, then 99% of people would not be invested in the stock market. So I currently pay 1.5%, 1.2% on my mortgage. That's more than enough to look at investing that money and trying to make more on it in another way. I also do pay off my mortgage monthly. That's just a really secure way of saving money by paying off, I think it's just £150 or £200 additional every month. That will cut my mortgage short by up to 6 years and save me 6-7 grand. But that's not something you need to do before you're investing in the stock market. Number three is have an emergency fund. So as a minimum, you should have 1 month's lean living as an emergency fund, ideally 3 to 6 months. Now, the reason why you want to have this is, well, you could lose your job and how you're going to pay for things, but also if you are investing in the stock market, you don't want external factors telling you when you need to take that money out. For instance, let's say you had been invested just before the stock market crash in February, March. Let's say, as an example, your boiler went in the start of March, just as the stock market was crashing, and you didn't have an emergency fund, so you couldn't pay for that to be repaired. Let's say it's 1.5, 2 grand to get a new combi boiler. So you're going to have to take that out of your investments. Now, you're taking that out right at the bottom of the stock market because you have no emergency fund, no other choice, which is fine. At least you can pay for your boiler. But now the stock market's gone back up, and actually that 1-2 grand boiler has probably cost you more like 3 or 4 grand in missed earnings from the stock market investment. So that's why you want to have spare cash free to be able to pay for anything that might crop up and let you decide on your own terms when you want to take your investments out. Okay, so you've sorted out your finances, you've paid off all your debts, and you've also got an emergency fund. So anything that crops up, you're going to be able to deal with. Now, as point number 4, you need to identify your investment goals. If your investment goals are quite short term, maybe you want to invest in your first home, investing and saving for a wedding, something like that, that maybe it's going to be 3 years, 4 years, anything probably below 5 years, investing in the stock market might not be the best thing for you, as the longer you're in the market, the more likely you are to have made money in that time period. Below, say, 5 years, there's a higher potential that you could be down. And if you're investing in a house and you want to save a deposit, you don't want to get to a point where you're going to buy the house and you don't have enough money because your investments have gone down. Similar for a wedding or something like that, where you know you're going to have a certain amount of money in 3 years' time. I would be very nervous about putting that within a stocks and shares investment. That's not to say there aren't other places you can invest your money. If I was a first-time house buyer, I would 100% be putting as much as I could, up to the 4 grand allowance, into a lifetime ISA. Now, I would put that into a cash lifetime ISA. You can get a lifetime stocks and shares ISA, but As I said, the risks involved in the stock market going up and down, I probably wouldn't risk it for that. And that gives you a 25% bonus. So for every £1,000 you put in, you get £250. So you can put up to £4,000. That gives you £1,000 extra. There is nowhere in the stock market you're likely to get those kind of returns. So if you are looking to save for a first house, 100% put £4,000 straight into a lifetime cash ISA. If you've got more to save after that, then maybe because you've got that safe investment in the lifetime cash ISA, then set up a stocks and shares ISA for the remaining money that you can risk, because you've already got that £4,000 or £5,000 every year banked in your lifetime ISA. My investment goals for my stocks and shares are long term. I'm going to be looking at if I can maybe reduce my working hours when I'm 50 or retire early. And that's why that money is safe and sound in the stocks and shares ISA. I can ride the stock market ups and downs, and as I get closer to 50, I'll start to relook at that, and maybe I'll buy into more bonds or something else that is low risk. So if your goals are long term, you can always change up your strategies as you go along. There's no point in thinking I'm going to stick with this same strategy from 20 or 30 or whenever you start investing, or 40 or 50 or whenever it is. You can always chop and change and decide to go down another avenue further down the line, but at least you know that you're not going to need to access that at any point earlier than you might otherwise want to. Okay, so you've decided that your goals match with investing in the stock market. The fifth thing you need to do is choose a platform that's right for you. Now, depending on what type of investor you want to be, whether it's active, whether it's passive, whether you want to be researching companies or just let someone else do it all for you, there's going to be different brokers and platforms that suit you better. You come across some of the bigger ones like Hargreaves Lansdown and AJ Bell. They have loads and loads of stocks and ETFs to offer. They also allow you to invest in things like index funds and mutual funds, which some other platforms don't. But they also come with fees and things like that you're going to want to consider. So what type of investor do you want to be? If you're starting off with not a lot of money to invest, then fees are going to be a big thing for you. So maybe you want to look at the Vanguard ISA, and you don't want to think about what you're investing in too much, just that you want to have that money invested. Maybe you actually want to get involved in the stock market and start picking some stocks. Then something like Trading 212 or Free Trade is going to be something maybe you want to look at, because you don't want to pay any fees, but you want to pick stocks and start learning about that kind of thing. And that's where I am. And now maybe in a year's time I'll decide actually I want to invest all my money in a Vanguard Life Strategy Fund and forget about it, or go with a mutual fund with something like Hargreaves Lansdown. And you can always change your mind later down the line. It does become a bit of a pain when you've got things like ISAs, because you need to port them to another provider. But, you know, it's just a bit of administration, and it is easily done. You might have to sell out of your current stocks and buy them back with another provider. But again, unless you've bought hundreds, it's not going to be the end of the world. And lastly, my sixth point is don't worry too much. I do get some comments on my channels with people worrying about whether they made a mistake going one platform or going with another, or investing in this, investing in that. And I'd say, if you're a newbie investor, you are going to make mistakes, but you've most probably got time to make that and learn from them. And we all learn from mistakes much more than we learn from our successes. If you pick the wrong platform, you can always move. If you pick the wrong stock, you can always sell out of it and buy something else. I would say, you know, if you're going in and starting a new portfolio, is try and mitigate some of them risks from the outset by buying a diverse range of stocks, different commodities, bonds, that kind of thing. That's always going to help you mitigate any losses, and it will potentially reduce some of your gains. And you need to be decided on how high risk and low risk you want to be. But you can always chop and change that as you move on. I've got a bond ETF within my current portfolio, and I'm in an R about whether I want to keep it there or not, whether I want to go higher risk and take out any kind of bonds at all. That may well happen, and I'm happy to do that. It's barely cost me anything. You can always start very small, and if you are a newbie investor, that's probably where you're going to be starting from anyway, unless you've managed to save a massive lump sum starting off. Don't worry too much. You are going to make mistakes. It's fine. If you go with the wrong platform, switch. If you decide actually I want to go with a growth strategy or dividend strategy or whatever strategy, you can always chop and change. I fully have not decided on any kind of investment strategy. I'm going with anything that I like to see. I'm going to be trying value investing. I'm going to be trying growth investing. I'm going to be trying dividend investing and see what suits me. Okay, so there's 6 points to think about before you invest in the stock market. Hopefully that's helped you out a little bit if you were umming and ahhing about whether you are in a position to invest. If you've been through that and you tick all those 6 points, then really now is the best time to invest. There's never a better time to invest than now. I would always say maybe have a little bit of cash left. If the stock market crashes, then you can always add in. But what you don't want to do at the same time is be sat at the sidelines and miss loads of growth, which you could have done if you'd taken all your money out in March and said, oh, I'm going to wait for it to go down again. It's gone up, it may well go down again. Who knows? I'm not going to predict that kind of stuff, and you probably shouldn't either. So just start investing, start small, start diversified. Happy days. If you are thinking about investing in the stock market and you've been looking at Trading 212, which is a platform that I personally use, I can personally say that as a newbie investor, I have been very impressed with it. And if you want to get a free stock when you start off, up to the value of £100, you can use the link below and you'll get a free stock worth up to the value of £100 when you sign up. And also I will get a free stock as well, so it helps me out and this channel. Anyway, that's it from me. Good luck investing. See you later.